Welcome, investors. Consumer credit card debt ticks up to well over $1 trillion. The unemployment rate ticks up. Number of new jobs comes down. What does that mean for interest rate, and what does that mean for your money? Let's find out. But before we do, if you find value from this video, be sure to like the video and subscribe to our channel so you can stay ahead of the curve with our weekly market videos. I'm your investment advisor, Jake Ackerman. Let's dive into it. All right, so this video is going to be really tailored on where interest rates are going. As data comes in, interest rates are going to fluctuate, but they're likely on a sustained path now going forward unless some big geopolitical event takes place, and then really all bets are off and we have to recalibrate and reanalyze what's taking place right now. So I want to start this video off with the theme of the Federal Reserve in the mind of Fed Chief Jerome Powell and the rest of the Fed officials. Let's start with this.
The best thing we can do for the U.S. is to restore price stability, fully restore price stability and not fail in that task, and do it as quickly as possible, but also with the least damage we can.
Restoring price stability, it means defeating inflation. With high inflation, there cannot be stable prices. This is the #1 mandate for the Fed right now. They have two mandates: maximum employment and price stability. Right now, they are laser focused on bringing inflation down and therefore restoring price stability. Even if we go into a bad economical time, they have to defeat inflation. But does that mean interest rates need to keep going up? A lot of companies reported earnings this week, and there's a pretty common theme. They are cutting costs. Take a look. All right, so you have this Amazon layoffs, 2023. What to know about the latest Amazon job cuts? This expands on more than 27,000 jobs over the last year. Citigroup considers deep job cuts for CEO Jane Fraser's overhaul called Project Bora Bora. Managers and consultants working with Citigroup reckon reorganizations have discussed job cuts of at least 10%. Google layoffs, 2023. What you need to know about Google. Charles Schwab lays off 5 to 6% of its workforce. Dorsey Block, formerly Square, to slash 1,000 jobs. Disney plans to slash costs by another $2 billion. 2023 layoffs, Dish Network cuts 500 employees. So does the Fed need to keep raising interest rates? Raising interest rates causes economical damage because with higher interest rates, getting credit into our economy becomes more difficult because the cost of the debt is more. When interest rates goes up, they have to pay more money on the debt. And also banks raise their lending standards because the cost of the debt is higher. That means they have to have more income as consumers, less debt to get credit. And that's the problem with raising interest rates right now. I mean, it's not necessarily a problem because it's bringing down inflation, but it is causing economical damage. So we had some data come out last week showing U.S. labor market loosens as job gains slow. Unemployment rate hits 3.9%. Non-farm payroll increases 150 in October, which was less than expected. Auto strike reduces payrolls by 33,000 jobs. Unemployment rate rises to 3.9 from 3.8. Average hourly earnings gain 0.2, up 4.1% year over year, which is less than expected. And the average hourly earnings really haven't been keeping up with inflation. That's why the consumer is being squeezed. And we have student loan repayment that just started October of this year. Well, actually, repayment started in September, but the first payment was due in October, which is also bringing constraint to the consumer. The big spenders, 18 to 44-year-olds, they're still spending. They are racking up an astronomical amount of debt right now, well over $1 trillion on consumer credit cards, because spending habits have become ingrained, and consumers don't want to slow down their current lifestyle. So they're going to max out their credit card until there's no more credit. Savings is going down. Credit card debt is going up. So the Fed doesn't necessarily need to raise interest rates because it's having the effects that they are wanting to see. This is the beginning stages. We're just starting to see this. Fed started raising interest rates March 2022. We're in November 2023. That's 16 months later since they've started. And there's something known as the lag effect of when they start raising interest rates till we actually start seeing in the economy. And that's anywhere from 12 to 24 months. We're 16 months in. We're just starting to see it. So this is going to take a lot of time to play out, but they're going to need to keep interest rates high. We have to understand that, because at the beginning of the video, you've seen the most important thing that they can do is to defeat inflation. So regardless, they're going to keep rates high. Take a look at the 30-year mortgage rate, even after the Fed meeting, saying that they're acknowledging the damage that they've caused, acknowledging the data showing a weakening jobs market, which is one of the goals they've stated that they need to see to defeat inflation. Take a look. This is the chart of the 30-year mortgage interest rate in the United States. And it's been ticking up, ticking up, ticking up, all the way that leads us into the last couple days, and finally, we're starting to see a little bit of relief. The question is, will that trend continue? Because markets are preemptive. At some point, the Fed is likely to cut as more damage is inflicted. And we need to understand they're going to keep interest rates high for as long as they possibly can, because they have to, until they probably break something. Obviously, they're going to try to avoid that, but we've seen some more, again, economical damage with unemployment rate, some more bank failures, a lot of job cuts. So this is what we need to expect over the course of the next 3-6 months to a year, that rates are going to remain high unless they can no longer keep interest rates high. The markets will preemptively start to come down, but take a look at the 30-year mortgage. It's not coming down in a straight line. It's going to take some time. So understanding interest rates are going to come down just slowly is how you can position yourself to make some money. Be prepared, understand the dynamics of interest rate market, what it does to the economy, what it does to stocks in this type of business cycle, what it does to commodities, what it does to bonds, and you'll be able to make wise investment decisions. We'll start to talk about those as things play out. So again, if you find value from this video, please be sure to like the video, subscribe to our channel so you can stay ahead of the curve. Expertise you deserve, experience you can count on.